stop everything you're doing. What I'm about to share is a story that isn't making headlines, but it could change everything you think you know about the global financial system. It's a quiet change, a subtle move, but it has the power to create seismic shifts. The entire financial world operates on one very fragile assumption, that gold always flows. It moves silently between vaults, banks, refineries, and nations. It's the ultimate bedrock, the final backstop when currencies start to look shaky. But just this past week, that fundamental assumption cracked. It happened without any warning. No press conference, no official explanation. China quietly, almost invisibly, suspended key gold-related services. And this sent immediate shockwaves through bullion trading desks from New York all the way to London. There were no tanks in the streets, no new sanctions announced. You won't see this story leading the evening news. But for those on the inside, the gravity of what just happened was instantly understood. This wasn't a technical glitch. It wasn't some routine system maintenance. This was what you might call a 1% change event. It seems small on the surface, but its implications underneath are absolutely massive. And once you see it, you simply can't unsee it. So, what actually happened? Several international bullion traders started reporting sudden, unexplained disruptions. They were having trouble with gold settlement, getting access to refining, and using export-linked services that are all connected to Chinese infrastructure. Think about it. Transactions that normally clear within a few hours were suddenly delayed. Some were rejected outright with no reason given. Others were just left hanging in limbo with zero official communication. Now, China didn't release a statement announcing a ban. They didn't use the word shutdown, and they simply stopped answering the phone, so to speak. And in the world of high finance, silence is often far louder and more terrifying than any public statement. Let's be clear, China isn't just another player in the gold market. They are a titan. China is one of the largest gold producers on the entire planet. They are also one of the world's biggest gold consumers. And crucially, they serve as a critical hub for refining, for vaulting physical gold, and for settling trades. So when services tied to a system that immense suddenly slow down, or worse, freeze, the entire physical gold market feels the tremor almost instantly. This is why this is so much bigger than it sounds. You see, paper gold, the kind you see traded on your screen, changes hands every second. But physical gold is a different beast entirely. Real solid gold has to be refined to a specific purity. It has to be certified. It has to be physically transported from one place to another. And then the transaction has to be settled. China sits right at the heart of that entire pipeline. By quietly putting restrictions on these services, China has effectively thrown sand in the gears of a machine that depends on speed and, most importantly, trust. Even a tiny 1% slowdown can trigger a massive chain reaction. We're talking about missed deliveries, which can break hedges that were put in place to manage risk. This can lead to margin stress for traders, and even force them to liquidate other assets to cover their positions. This is how financial accidents start. They don't begin with a loud explosion. They begin with quiet, unexplained delays. And the timing of this move is no coincidence. Let's look at the context. This is happening at a time when U.S. debt issuance is absolutely exploding. Treasury yields remain unstable, making government bonds less attractive. Meanwhile, central banks around the world are buying physical gold at a record-breaking pace. And the conversations around de-dollarization, moving away from the U.S. dollar as the world's reserve currency, are no longer on the fringe. They're becoming mainstream. Gold has already been under pressure from the paper markets, from algorithmic trading, and from volatility in derivatives. But the demand for physical gold has remained incredibly strong, especially in Asia. So, you have to ask the uncomfortable question, why would you restrict gold services right when physical demand is soaring? History gives us a chilling answer. Every single time a major global power quietly tightens its control over gold, it signals preparation, not panic. In the past, similar moves have come right before major currency realignments. They've preceded the implementation of capital controls to stop money from leaving a country. They've signaled strategic accumulation of reserves, and they've often happened just before major geopolitical shifts. Gold is not just another commodity like oil or copper, it is monetary insurance. You don't lock the vault unless you are expecting a storm. So why is Wall Street so nervous, but not talking about this publicly? Officially, the line is that everything is fine, business as usual. But unofficially, behind closed doors, bullion desks are frantically recalculating their risk models. These models were all built on the assumption that gold liquidity is infinite, that you can always buy or sell it. But it's not. It never was. If China decides to prioritize its own internal gold flows over international settlement, even just slightly, it immediately tightens the global supply of physical gold. That pressure doesn't show up right away in the spot price you see on TV. First, it shows up in other, more subtle places. It appears in the delivery premiums, the extra cost to get your hands on the actual metal. It shows up in discrepancies between the price of physical ETFs and the gold they supposedly hold. You see it in the spreads on futures contracts. And eventually, you see it in physical shortages. The price you see on the screen is the last thing to move. By the time the headlines are screaming gold crisis, the big players have already made their moves. The positioning is already done. This is the 1% change that can break the entire system. Markets don't collapse because of a 50% drop overnight. They collapse because of small, critical changes in the underlying plumbing. A 1% delay in settlement, a 1% reduction in available supply, a 1% loss of trust between the parties in a transaction. That is all it takes. When that confidence breaks, the massive leverage built up in the system does the rest of the work. China didn't need to make a dramatic announcement. They didn't need a grand gesture. They only needed to change the flow, and they did. So, what happens next? If this pause on services continues, or if it expands, we can expect a few things. First, increased volatility in gold futures, as traders react to the uncertainty. We'll likely see a growing divergence between the price of paper gold and physical gold. Central banks will probably accelerate their buying, trying to secure their reserves. And more questions will be asked about who actually controls the world's gold supply. But most importantly, expect more silence. Because the most powerful financial moves are no longer announced with a megaphone. They are executed quietly, behind the scenes, while everyone else is distracted by the daily noise. This is my final warning. This is not a prediction of a specific event. This isn't hype. This is simple pattern recognition. When a nation as powerful and as central to the gold market as China restricts gold services without any explanation, it's not reacting to yesterday's news. It's positioning for tomorrow's reality. And history shows that when gold starts moving quietly behind the scenes, currencies are usually the next domino to fall. The whole world is watching interest rates and inflation. But the real game is being played in the vaults. If the first part of this story was the shock, this part is the slow dawning realization. Because after China quietly put a halt to key gold services, something strange started happening across global markets. It wasn't loud or dramatic. Gold didn't suddenly rocket higher. Stocks didn't crash. The dollar didn't collapse. No, something far more dangerous happened. Everything stayed calm. And in the world of finance, when markets stay eerily calm after a major structural disruption, it usually means one thing. The big players are quietly getting into position behind the scenes. The silence itself is the signal. Within hours of the disruption, major Western media outlets were quick to dismiss the situation. They called it temporary or an operational issue. There was no emergency coverage, no breaking news banners, just quiet footnotes. But in global finance, what isn't said is often far more important than what is. Almost immediately, bullion banks started quietly widening their spreads. Physical dealers began adjusting their delivery timelines. And when asked for comment, central bank desks went completely silent. This wasn't a sign of confusion. This was containment, because they all know that once confidence in gold settlement begins to crack, it doesn't just affect the price of gold. It affects the value of everything priced against it. So, why is the United States watching this so very, very closely? Officially, the US dollar isn't tied to gold anymore, not since 1971, but the entire system still secretly depends on gold as an anchor of confidence. Here's the uncomfortable truth. Gold is what underpins trust in a country's balance sheet. It backs a nation's credibility, especially when its debt levels are exploding. It's the ultimate stabilizer during times of currency stress. And right now, US debt is growing at a pace the world has never seen before. China knows this. By slowing down its gold services, notice, not banning, not seizing, just slowing, China is testing a critical question. Just how fragile is Western confidence without the smooth, uninterrupted flow of physical gold? Even a tiny 1% disruption can expose the massive leverage that's been built on the assumption of endless, frictionless liquidity. This brings us to the major fault line in the system, the difference between paper gold and physical gold. On paper, gold trades endlessly. We're talking futures, options, ETFs, just numbers flying back and forth at the speed of light. But physical gold is a different beast entirely. It has to be delivered, it has to be verified, it has to be settled. China's move targets that exact pressure point. When the settlement of physical gold slows down, a few things start to happen. Futures contracts suddenly lose their credibility because the promise of delivery becomes questionable. ETFs risk tracking errors where their price disconnects from the actual metal they're supposed to represent. And most importantly, arbitrage, the process that keeps prices consistent across different markets, breaks down. When arbitrage fails, price discovery fails. That's the moment when volatility explodes, not because demand suddenly spikes, but because trust has completely disappeared. This leads to a question a lot of retail traders are asking: why isn't gold going up? But that's the wrong question. The correct question is, why hasn't gold been allowed to react yet? In past crises, we've seen prices get managed and suppressed temporarily to prevent widespread panic. This keeps things calm on the surface while the big institutions reposition themselves. By the time the price finally moves, it's already too late for everyone else. History shows us this pattern again and again. First, you get stability. Then, you get the repricing. And last, you get the assignment of blame. The calm you're seeing in the markets right now isn't a sign of reassurance. It's the sound of preparation. This move fits perfectly into China's long-term strategy. For years, they've been quietly increasing their gold reserves, systematically reducing their reliance on the US dollar, building alternative payment and settlement systems, and strengthening trade deals that bypass the SWIFT system altogether. This disruption of gold services isn't about today's price. It's about securing tomorrow's leverage. Gold becomes true power when other people desperately need it, and you are the one who controls the flow. China didn't just weaponize gold, they simply reminded the world who really matters in the physical supply chain. And what are the central banks doing right now? While the headlines stay quiet, they're doing the exact opposite of nothing. They are buying. And they aren't buying ETFs or paper contracts. They are buying physical gold, taking delivery, and putting it in their vaults. And they are definitely not talking about it. That's because central banks don't chase momentum. They try to front-run instability. When official institutions start moving in silence, it is never an accident. Systemic collapses don't start with massive, spectacular failures. They begin with minor inefficiencies that start to compound. A delayed shipment here, a settlement dispute there, a margin call somewhere else. Each one of these seems manageable on its own, until they all connect. And when they connect, that's when markets reprice violently and suddenly. That's how a small 1% change snowballs into a 10% move. It doesn't happen overnight, but it happens inevitably. This is why the retail trader almost always loses the first move. Retail traders react to headlines. Institutions react to the plumbing of the financial system. By the time gold volatility makes it to the mainstream news, the big players have already built their positions. Their risk is already hedged, and their profits are already locked in. The average person is left chasing a story that has already played out. This is why understanding the structure of the market is so much more important than just watching the price. And China just altered that structure. Let's be clear, this was a test. China didn't shut down its gold services forever. They tested the system. They watched the reactions. They measured the stress points. They took notes on who panicked and who didn't. That data is priceless to them. If the system absorbs this small disruption smoothly, you can expect another, slightly bigger test down the road. If cracks start to appear, you can expect them to escalate their actions. Either way, the direction of travel is clear. Gold is no longer just a simple hedge against inflation. It's becoming a strategic, geopolitical lever once again. And when gold becomes political, markets never stay calm for long. The real question isn't if prices will move, it's who will be positioned correctly when they do. We've gone through the moves, we've broken down the mechanics, and now it is time to talk about the truth that no one in power wants to say out loud. This was never just about gold services, it was always about power. The moment China quietly changed the rules for gold settlement, it put Washington in a position it has avoided for decades. It forced them to face a harsh new reality. Controlling the world's money no longer means you control the entire system, and that changes everything. Let's be clear about why this is such a direct challenge to the United States. The US dollar sits at the top of global trade for one simple reason: trust. Not trust in American politics or policies, but trust in settlement. Oil deals settle in dollars. International debt settles in dollars. When a crisis hits, the world runs to the dollar for settlement. But gold has always been the silent referee in this game, the ultimate asset of last resort when confidence in everything else begins to crack. By tightening its grip on gold flows, China didn't launch a head-on attack against the dollar. They did something much, much smarter. They went after the backstop. They targeted the very foundation that supports the entire system when things get shaky. This is exactly what modern financial warfare looks like. There are no sanctions, no tariffs, and definitely no splashy headlines. It's just quiet, surgical pressure applied to the system's most sensitive point. Think about it. A slight disruption in how gold is settled might not seem like a big deal, but it does three critical things. First, it tests the trust between major financial players. Second, it exposes how much leverage and borrowed money is sloshing around. And third, it reveals just how dependent the West is on a smooth, uninterrupted global pipeline for gold. China just sent a powerful reminder to everyone about who controls a very important valve in that pipeline. So why can't the US just come out and respond to this? Here's the dilemma Washington faces. If the US government acknowledges the threat, it gives it legitimacy. It tells the world, yes, this is a real problem. But if they ignore it, they risk losing control behind the scenes, bit by bit, without anyone noticing until it's too late. So what do? They stay silent. No denials, no confirmations, and absolutely no explanations. Admitting there is a vulnerability in the gold market would open a Pandora's box of very uncomfortable questions. Questions like, how much physical gold is actually available for delivery right now? How much of that gold has been loaned out or pledged multiple times over? And how much could truly be delivered if a major player demanded it tomorrow? These are questions the financial system simply cannot afford to answer in public. This brings us to the great standoff between gold and the dollar. For years, people thought China's big move would be to dump its US Treasury bonds. That's old school thinking. Gold works better for them, and here's why. Selling massive amounts of treasuries would hurt China's own portfolio, but controlling the flow of gold doesn't. In fact, it strengthens their credibility. Gold can be used to settle trade deals. Gold is immune to sanctions. By positioning gold as an alternative anchor for settlement, China is slowly, carefully decoupling global power from the dollar without ever firing a shot. This isn't about replacing the dollar overnight, it's about erosion. And erosion is a slow, creeping force that's much harder to stop than a direct assault. If you know your history, this should all feel very familiar. Major shifts in the global monetary order never start with a big announcement. They begin with subtle clues, restricted flows of assets, quiet accumulation by central banks, the creation of alternative systems, and a deafening silence from officials. The Bretton Woods system, which made the dollar king, didn't collapse in a single day. It decayed for years under the surface, and then one day it just snapped. What we are witnessing right now follows that exact same pattern. Gold is being pulled back to the center of the financial stage, slowly, deliberately, and strategically. China's move isn't just a signal. It forces the United States into a corner with only two ways out. Option 1, maintain the illusion that gold is just a shiny, irrelevant relic. Option 2, prepare for a new system where gold matters again, a lot. There is no third option. Because once gold becomes a political tool, the idea of staying neutral disappears, and you can be sure that global markets are not prepared for that kind of shift. So what is the smart money doing right now? They're not just chasing the price of gold on a screen. They are securing three crucial things: physical access to the metal, jurisdictional safety, meaning storing it in a place they trust, and settlement certainty. They are asking the questions that matter most. Can this gold actually be delivered to me? Who is in control of the vault where it's stored? What happens to my claim during a major financial crisis? These are the questions that don't show up on a price chart, but they are the ones that will ultimately decide who wins and who loses. Here's the most important part. The next big move probably won't come from China. They've already made their play. Now the pressure shifts. It shifts to Western central banks, to the big bullion banks that trade massive amounts of paper gold, to the commodity exchanges, and to the currency markets. Someone, somewhere in that chain, will break first. It could be a failure to deliver on a contract, a sudden liquidity crisis, or a bizarre pricing anomaly that can't be explained away. That's how these hidden pressures always surface. Not with a warning, but with a crack. Let's have a final reality check. This isn't about predicting the price of gold next week or next month. It's about recognizing a fundamental structural shift in the global financial system. Gold is no longer just a hedge against inflation. It is once again becoming a settlement tool, a political instrument, and a core strategic reserve for nations. And history shows that when gold steps back into that powerful role, markets don't just gently adjust, they reprice violently. The United States and China are now engaged in a long, strategic game. It's not a game over territory or technology, but over something far more fundamental: monetary credibility. Every financial system has a limit, not a date, not a warning, a stress point. And once that point is crossed, things don't unwind slowly. They break, suddenly and without warning. We've seen hints of this recently. After China quietly put restrictions on its gold services, after the West seemed to pretend that nothing happened, and after the market stayed eerily calm, we are now approaching that limit. This is the phase most people never see coming, the quiet before the storm. Right now, if you look at the surface, the global gold market is still functioning. It's working. Contracts are clearing. Gold ETFs are trading. Prices are moving within what analysts call normal ranges. But underneath that calm surface, the tension is building. It's like a deep current pulling everything taut. Gold liquidity is thinning out. Delivery times for physical metal are stretching longer and longer. And counterparties, the big players in the market, are demanding stronger guarantees from each other. This isn't panic. Not yet. This is defensive behavior. And defensive behavior always comes before a rupture. So what actually triggers the break? What's the moment it all goes wrong? It won. Now, to be a dramatic headline flashing across your screen that says, "Gold market collapses." It will be something far more mundane, something technical, buried in the financial jargon that most people ignore. It might look like a delayed delivery at a major exchange, or a settlement extension announced for operational reasons. Maybe a company quietly invokes a force majeure clause, or you see a sudden unexplained change in contract terms. These are the moments that don't trend on social media. They don't become viral videos. But they are the moments that change history. Because once a single delivery fails, confidence begins to cascade downwards. And in the world of paper gold, confidence is the only thing holding the entire system together. It's the glue. Once that glue dissolves, everything falls apart. Here's the reality that Wall Street and the big financial institutions try to avoid discussing in public. There is far, far more paper gold than there is physical gold. We're talking about contracts, ETFs, futures, all claims on gold that don't have a one-to-one backing with actual metal in a vault. This imbalance works, it functions, but only until too many people ask for delivery at the same time. China's recent move to restrict gold services didn't create new demand out of thin air. What it did was redirect existing demand. It pushed people and institutions away from paper promises and toward the certainty of physical metal, the kind you can hold in your hand. When major institutions start asking the critical question, can you actually deliver on this contract? Everything changes. Because the honest answer is, not everyone can get delivery. There simply isn't enough to go around. This brings us to the weakest link in the entire chain, the commodity exchanges. Exchanges like the COMEX survive on one thing and one thing only: trust. As long as every participant believes that settlement will happen, that the gold will be there if they ask for it, the system holds. But here's the secret. Exchanges don't stockpile enough gold for everyone. They don't have a giant vault with every single bar for every single contract. They rely on a few key mechanisms to keep the machine running. They roll contracts forward. They offer cash settlements instead of physical metal. They use delays and call them flexibility. All of this works perfectly in calm, stable markets, but it fails spectacularly under stress. And China AS' quiet disruption of its gold services added a huge amount of stress to the wrong part of the system at the worst possible time. It was a test, and the system showed its cracks. So how does it all unfold? It starts with what seems like a tiny 1% event. A single delivery issue forces a quiet settlement adjustment between two parties. Then, one large player, seeing this, opts for cash instead of waiting for metal they might not get. Another player sees that and demands physical delivery, just in case. Suddenly, the spreads between bid and ask prices widen. Liquidity, the ability to buy and sell easily, dries up. Volatility spikes. At no point does the system send out an alert saying, warning, failure imminent. It simply becomes unusable for those who need certainty. It just stops working for anyone who wants real, physical gold. And that buys the moment when the price of paper gold completely disconnects from the price of physical reality. Most people expect gold to rise steadily before a crisis. That's a common misconception. Historically, gold doesn't rise before the crisis. It explodes after trust breaks. Before the break, prices are managed. Volatility is suppressed by central banks and large institutions. The dominant narratives are all about control and stability. But after the break, the only thing that matters is delivery. Physical premiums explode. The paper price you see on your screen becomes irrelevant, a fantasy. This is why gold crises always look so sudden to the general public, but they feel completely inevitable to insiders who were watching the signs. And gold doesn't fail in a vacuum. Once the settlement of gold becomes questionable, the US dollar itself starts to feel the pressure. Not immediately, not dramatically. But subtly, the questions start. Foreign holders of dollars, central banks around the world begin to ask, what really backs this system now? And what happens if we're hit with sanctions? In a major global dispute, what do we use to settle trade? Gold answers those questions far better than promises from politicians. And that is the ultimate danger to the current financial order. This brings us back to China's position at this breaking point. China doesn't necessarily need chaos. What they need is optionality. They need choices. If the current system holds, they gain leverage within it. If the system cracks, their preparation gives them massive influence in whatever comes next. Either outcome benefits them because they prepared. This is why their move was so silent, so under the radar. Noise creates resistance. Silence creates dependence. The world is becoming more dependent on the players who hold the real assets. So what does smart money do when we approach this breaking point? They don't chase charts. They don't listen to the talking heads on TV. They secure three things: physical ownership of assets, clear title to those assets, and jurisdictional safety, meaning they hold it in a place where it can't be easily confiscated. They want immediate access. They stop asking, what's the price going to be next week? And they start asking, will it be there when I need it? That is the exact moment gold stops being a trade and becomes what it has always been: financial insurance. Here's the final warning. The break doesn't ring a bell. There will be no public service announcement, no last chance banner on your brokerage account. The break happens quietly in the background, in the plumbing of the financial system. Then, prices gap violently. By the time the public realizes something is fundamentally wrong, The system has already chosen its winners and its losers. China's move didn't cause this impending crisis. It simply revealed where the system is weakest. And when the pressure returns, as it always does in finance, that weakness is exactly where everything will give way. Every financial system has a limit, not a date, not a warning, it's a stress point. And once that point is crossed, things don't just unwind slowly, they break, suddenly. We saw a glimpse of this after China quietly restricted some gold services. We saw the West pretend nothing was happening. We saw markets stay eerily calm. But don't be fooled. We are now approaching that limit. This is the phase most people never see coming. Right now, the global gold market is still technically functioning. Contracts are clearing, ETFs are trading, prices are moving within what they call normal ranges. But just beneath that calm surface, tension is building. Gold liquidity is thinning out. Delivery times are getting longer. Counterparties are starting to demand stronger and stronger guarantees. This isn't panic, not yet. This is defensive behavior. And defensive behavior always comes right before a rupture. So what actually triggers the break? It won't be a dramatic headline flashing across your screen that says gold market collapses. It'll be something boring, something technical, something most people will ignore. It could be a delayed delivery at a major exchange, a settlement extension for operational reasons, a force majeure clause quietly invoked in the fine print of a contract, or a sudden unexplained change in contract terms. These are the moments that don't trend on social media, but they are the moments that change history. Because once just one delivery fails, confidence doesn't erode, it cascades. And confidence is the only thing holding the paper gold market together. Here's the reality that Wall Street and the financial media desperately try to avoid. There is far more paper gold in existence than there is physical gold to back it up. That imbalance works just fine, as long as everyone plays along, but it only works until too many people ask for delivery at the same time. China's move didn't create a new wave of demand out of thin air. What it did was redirect existing demand. It shifted focus from paper promises toward physical certainty. The real trouble starts when major institutions start asking the simple yet terrifying question, can you actually deliver the metal? Because the moment they ask, everything changes. The honest answer is that not everyone can get what they were promised. This brings us to the weakest link in the entire chain, the exchanges themselves. Commodity exchanges, like the COMEX, survive on one thing, trust. As long as every participant believes settlement will happen as promised, the system holds together. But here's the secret. Exchanges don't stockpile gold for every single contract holder. They rely on a series of financial maneuvers. They roll contracts forward. They encourage cash settlement. They use delays and disguise them as flexibility. This all works beautifully in calm, predictable markets, but it fails spectacularly under stress. And China's disruption of its own gold services added a huge amount of stress to exactly the wrong place at exactly the wrong time. So how does it all unfold? It starts with what looks like a tiny 1% event that triggers a massive chain reaction. A single delivery issue forces a quiet, behind-the-scenes settlement adjustment. Then, one large player, sensing trouble, opts for cash instead of waiting for metal that might not arrive. Seeing this, another major player demands physical delivery, just in case. Suddenly, the spreads between buy and sell prices widen dramatically. Liquidity dries up, volatility spikes. At no point does the system announce its own failure. There's no official press release. It simply becomes unusable for those who need certainty, for those who need the actual physical gold. And that is the precise moment when the price of gold disconnects from reality. The paper price becomes a fantasy, while the price for physical metal goes vertical. Most people expect gold to rise before a crisis, but historically, that's wrong. Gold explodes after trust breaks. Before the break, prices are carefully managed. Volatility is suppressed by central banks and market makers. The official narratives dominate the headlines. But after the break, the only thing that matters is delivery. Physical premiums explode. The paper price becomes irrelevant. This is why gold crises always look sudden to the public, but they feel completely inevitable to insiders who were paying attention. And a failure in the gold market doesn't happen in a vacuum. Once gold settlement becomes questionable, the US dollar itself starts to feel the pressure. Not immediately, not dramatically. But subtly, the questions begin. Foreign holders of dollars start asking, what really backs this system now? What happens to our assets under sanctions? What settles international trade when there's a major dispute? Gold answers those questions far better than any political promise or government decree, and that is the ultimate danger to the current system. Now think about China's position in all of this. China doesn't need to create chaos, they just need optionality. They've been preparing. If the Western-led system holds together, they gain leverage within it. If it cracks, they gain massive influence over what comes next. Either outcome benefits their long-term preparation. This is exactly why their recent move was so quiet, so subtle. Noise creates resistance, silence creates dependence. So what does smart money do when we're at this breaking point? They don't chase charts or listen to talking heads on TV. They secure three things: physical ownership of assets, clear title to those assets, and jurisdictional safety, meaning they hold it somewhere they can access it. They stop asking, what's the price today? And they start asking the far more important question, will it be there when I need it? That is the moment gold stops being a trade and becomes what it has always been: financial insurance. And here's the final warning. The break doesn't ring a bell. There will be no public service announcement, no last chance to get out banner ad. The break happens quietly behind closed doors. Then prices gap violently, often overnight. By the time the public realizes something is fundamentally wrong, the system has already chosen its winners and losers. China's move didn't cause this crisis. It simply revealed where the system is weakest. And when the pressure returns, and believe me, it always does, that weakness is where everything will give way. Gold doesn't warn, it reprices, and the next repricing won't be small. Thanks for watching. If you found this valuable, make sure to subscribe for more insights.